I'm Joseph Novichkov, Senior Trading Manager with GDM. Welcome to today's webinar. First of all, please accept my apologies. We're just a few minutes late from the initial start of today's webinar. We've been having some issues due to the recording of today's webinar, so we had to suspend the issue at hand, fix all of the things and the experience of all of our attendees at this stage. However, we're also on schedule to present one of our first parts of the technical side of this month's webinars. Well, what we're focusing mostly this month, ladies and gentlemen, is the technical and fundamental analysis and how to combine both. This is probably the main topic. Today, however, we will focus on the most simple way to combine both. This would be a simple system by following a trend with a few moving averages, and as I mentioned on our last webinar, we're mostly focusing on volumes. However, the final session of this month's webinars, this is on Friday this month, this Friday, we're going to be talking about a bit more advanced type of technical system that could be also combined with fundamental side of the market, which would be approximately 3 to 4 different systems. It really depends on the time that we would be able to have in our hands. I do not want to take too much of your time. However, today's session is very important, therefore it will be absolutely separate because we need to get a little bit more closer to what is technical and fundamental analysis, and when the combination with both analysis we actually develop a very powerful type of system. We do understand that the performance of the technical analysis and the application to all various charts and time frames, so on and so forth, the actual study of the components of a particular currency pair or a commodity, let's put it this way, could be somehow vague to the actual condition of any particular economy that is right now. So speaking of the euro versus the dollar, we can see the most simple particular technical system at hand. We have 3 moving averages, as we spoke the last time. We have a volume indicator. We can see the particular trend, especially this one here. Let's talk about this one. As we mentioned earlier, the 1 hour time frame is by far the most important and probably the most useful intraday trading time frame when it comes to technical plus fundamental analysis. One of the ways and probably one of the reasons why we have switched from 4 hour time frame to 1 hour time frame in our technical recommendations that we are used to do daily, twice a day, once in the European session, once in the US session, and it's basically available for free for pretty much anyone that have the desire to receive that particular recommendation. And of course you have to be always advised that it's for educational purposes only. The very simple reason why we focus on technical and fundamental analysis this month is due to the all-important economical and geopolitical reasons that have happened so far due to, for 2016. We saw, as we spoke the last time, we saw the vote for a British exit from the European Union. We also saw the Italian referendum losing ground, also the Prime Minister resigning, so on and so forth. The same happened in UK, let me mention that as well. We saw the US presidential elections. The outcome was pretty much unexpected for most markets. We also saw the second Federal Reserve rate hike in the past 10 years. We also saw the tensions in Japan, Europe, also Brazil, in South America. We saw the impeachment of the president over there. As well in South Korea, we can see the same thing happening over there as well. By far, the most important year for the past 10 years, when we exclude Ben Bernanke's bond buying program, which was one of the foundations of the actual economic growth of the United States. We also saw the his his selection for the Fed chair, which is at the moment Janet Yellen. She's doing pretty good at the Federal Reserve's chair, and the rate hikes, the openness of the situation right now in the U.S. So basically, all of these factors are giving us a lot of information to work with. That's the one thing from the fundamental side. Carefully assessing all of this, we can basically say what we can expect for the first quarter of 2017. Well, when we say that 1 year could be split on 4 equal parts, 4 by 4, which means that every quarter, every 3 months, we can actually expect at least 1 rate hike from the Federal Reserve. Now, this would be the logical side of every particular mind if we are going to go fundamental plus technical, which means from the first 3 quarters we might see a rate hike or not, but we have to be prepared for all this. Now, speaking about rate hikes, we know that the dollar tends to rise after the rate hikes are, have been risen, or on the speculation of such event as well. However, rare in the Forex market, successful traders, please follow on this one, can actually carefully assess the market from fundamental and technical side to properly position themselves, whether from the risk side of the market, if you're hedging, if you're a firm, if you're a logistic firm, for example, and you hedge yourself against the fuel that you're actually using to deliver particular packages all over the world, or just in a single country or town, if you're a small one. You have to hedge yourself against the biggest thing that you use to grow your particular business, and that would be in the case of petrol goods like oil, or the Brent, or the crude, or the sweet, or the ice Brent, whatever it is, whatever market that you have chosen to hedge yourself, you definitely have to be on the particular right side of the market, because if you have a logistic firm and you hedge yourself with positions on oil futures, now if you're using fuel to deliver particular packages at point A to point B, that would cost you a certain amount of fuel. Now this one you have to hedge it on the market, therefore you need to know market conditions. Right now, speaking from the oil side, we are expecting, as promised from OPEC and non-OPEC producers, to cut production from the beginning of 2017. Therefore, we can expect oil prices to start rising slowly after they have stabilized throughout December. Now, what we see right now is stable to upwards direction of oil prices. Let me just go for chart only here. Now, as we can see, the prices have stabilized somewhere in the midst between the $52 a barrel and the $55 a barrel. Now, if we have stabilized at certain conditions like these, we can carefully assume that prices above $55 per barrel, of course, they would be quite appropriate for some amount of time. We don't know for how long these conditions could be sustainable. However, what we see on our weekly chart right now is a condition around $59 or $60 a barrel, between 60 and 62. A point from where, on a weekly chart, there is a pivot point here, ladies and gentlemen, around these conditions, which means if oil prices rise above these levels and the fundamentals are supportive after the OPEC and non-OPEC producers start slowly cutting production on weekly basis by the promised 1.9 million barrels per day, that would mean that careful, slowly but surely, another, what we can say here is about $12 a barrel trend could occur. That's from the technical side. So, as I mentioned earlier, carefully assessing fundamentals and, of course, comparing that to technicals, you would be very successful on the market. See, this particular case here, with multiple dodges and market uncertainties, was from where actually the market was on a free fall with another $33 in about 38 weeks. That's a full year, almost a full year of declines. We have 52 weeks in a year. We have a little bit less, but that's quite all right. The year before, however, we saw another 32 weeks with $60 of decline, pretty much on the same reason. However, as this reverse head and shoulders formation, we can see it over here. Let me just go for it and do like this. Expand it for you so we can see it. You can see that reverse formation. We can see that it's right now confirming above that neckline. However, we have a pivot point on the weekly basis here, which means our shoulder on the right side could extend a little bit further around this level. Therefore, confirmation above the $62 a barrel from a technical standpoint would be the most appropriate way to approach the market towards another $12 of gains towards the 75 mark. Now that would be, of course, if we don't have anything other on our charts to stand on our way. We can see this case as well again here. This is why, ladies and gentlemen, from the beginning we have started with pivot points, support and resistance levels, because they're very important. When we speak about technicals plus fundamentals, we're always going to aim for a higher time frame to see in the long run whether there's something that is standing on our way towards our goal. We have an objective. We have to go from here to there, from point A to point B, which means from zero to profits. To get to that profit, we need to see what are the obstacles during that particular travel. Now, if you have obstacles like any fundamentals that could stop us, or any technical levels which are strong that could actually block our way towards our final goal, which in actual language would be about the $75 a barrel here, because we can see that from here on there is a lot of support during that time here, which means now it's a resistance level, which obviously is a very strong one and is our goal. Basically, we have to go there. We're looking for it. Meanwhile, we have some minor resistance levels around the 68. We can see speaking of the between 58 and 62, that's about $4 range, which we can say that it's a pretty strong one. Therefore, it's a pivot level from where we can start looking to the upside. And there are also other minor levels like the 84 for further upside if you're going to leave some positions for longer term. The 87, we can see the 91 or 92 level is also one. Furthermore, now if I'm going to entered this particular range from here to the upside down here, up there, that would be rather sideways direction than actual trend that I'm going to be looking for. So my final goal is 75. If from then on I see further upside, supportive fundamentals, of course, some part of my position, 1/10 or two-thirds or whatever part of your position you want to leave open, you would be most welcome to do so, because you have already secured your profits. You have already closed a large part of your positions. And now on, everything up there would be a bonus and a credit to your own good work. To do so, again, we have to carefully assess all fundamentals. Speaking of oil, however, right now the odds are slightly better than if we're looking for gold or any particular currency pair which is traded versus the greenback, for example. Mostly on the strength, the potential strength of the dollar, let me put it this way, because the dollar is retreating a little bit for the past few days, and I have predicted that for gold, if you remember, when we spoke about the rate hikes the last time, also the session before, we've been talking about furthermore fundamentals connected to gold and currency pairs as well. I spoke about the potential bounce back of oil prices. We saw that yesterday alone. Let me just bring it out here. Yesterday alone, gold prices jumped with about $12 to $13, something like that, in a matter of minutes. That happened just in the wake of the European session. Now, I don't really know particularly who it was messing with the webinar's computer, to be honest with you guys, but the particular charts are not exactly those that I've been used to use. However, we don't really need any particular instruments on it. We're mostly focusing on the trend at hand, which is by far the most important thing right now. So we have seen that level here as we spoke the last time. Okay, we saw the 1137 as the peak, the top level of the current of the previous range, which was from 1127 to 1137. That's a pretty tight range, speaking of gold prices. Once that level was broken, you can see here the price immediately shot up with about $12 to $13, and that happened in about 2 to 3 hours, something like that, in between the openings of the European session. I was actually waiting for that move from a few days before that. Okay, that happened before Christmas, you know, the downward direction, the tests here of the 1125-24 level, which was quite sustained. As expected, I had a long position which was opened in the midst of 1133. That's the mid-range of 1127 and 1137. Somewhere in the middle of this one, I've had a position which I have closed somewhere around this stage. So you can see that's $14 in about 16 hours of trade, or let's say a little bit longer because I've had it long before Christmas. But that particular rally of gold prices, I've waited to happen a few days earlier. However, it actually happened on the first trading day after Christmas, and that was mostly on physical buying, on technical rebound. See, here we don't have fundamentals. We have mostly technical patterns, formations, so on and so forth, that actually suggested an upside. We can clearly see that on the 4-hour time frame. We see that double bottom here, the actual confirmation comes above the 1142, and you still have about $10 of profit. Now, if you have carefully assessed the situation by suggesting there are not going to be any more technicals after the Friday before Christmas, I will wait for the final numbers, which were rather mixed for US. We saw the consumer confidence, we saw the durable goods orders, so on and so forth. All of these numbers were rather mixed. We saw the what was the trade balance, so on and so forth. So you see, everything came out. Me personally, I didn't care about the numbers themselves. I knew that gold had found a particular bottom around the 1122, but that was a point from where I couldn't really allow myself to buy, because that's on the bottom of a downtrend which could actually continue if it had broken down through that level. So now I would be in a deep waters here. Therefore, I would carefully see that particular second bottom here, then another bounce, and from then on, 1133 was my cue. $14 in about a few days. Let's put it a week, if you wish. A week. Now that's $1,400 on one lot. $14,000 on 10 lots. And if you have an account that could actually sustain 100 lots, well, that would be a very good paycheck for about a week. It's $140,000 only throughout Christmas. It's a pretty good gift, I would say. However, my focus right now is not to calculate the potential profit, but actually to show you what we are in right now. No fundamentals for gold, thin trading, but sending the price up. In the meanwhile, our oil prices on that 4-hour time frame, sorry, let me just get rid of that particular circle here that I've placed, which I can't seem to get rid of. There it is. And get down to the 4-hour chart. During that time, you can see here was, there it is, 23rd was here, 24th, 27th. Gold was, oil was still well supported, but in a sideways direction, mostly, before it actually broke through that 53.80 area, which we actually signaled this morning a potential further upside if that 54.40 area is broken. Now this is a technical level, which we all are looking at for further upside. We all know every technical trader, if is going to be looking for an upward direction, before that the particular individual will be looking for a better price, so that means lower price. But the smarter trader that actually do not have the amount of funds to support the negative side of the market for the long term, you would be looking for the technicals plus fundamentals. Now, the fundamentals for oil are well supported. Therefore, you're going to start looking for the technicals until something else happens on the fundamental side that you have to start worrying about, or that is actually going to reassure yourself that the market will continue your way. Therefore, if you don't want to suffer the negative side of the market, you would be definitely looking for a daily confirmation above the 53.80 area, and with a break above the 54.50 or 40, whatever that is, 54.50 let's say, you would be looking to add to your potential upward direction, because the next potential move would be for, as I mentioned, the first resistance area at 56.40. Now that's about $1. Some from here is about $2.50. Now that's $2,500 on one lot, and again on 10 lots that's $25,000, $250,000, or $250,000 on 100 lots. Let's put it this way. So you see, calculations are very easy to make and to actually assess potential profit or loss. We've all learned how to do that. But to know when to enter the market and to hold it for the amount of time where is the actual maximum of this profit, now that is the hard part. That is why we should not underestimate the power of technical plus fundamental analysis. Now, what we see here today in this session is by far the very simple way of trading the markets. Using just a chart, or in that case here, the only thing that we need, a few moving averages to point a particular trend or support or resistance. If we don't want to make the calculation we've learned earlier this month to better find, of course, support, resistance, and pivot points. By far, that would be the best way I would approach the market, because the levels would be much more accurate. Fluctuations like this one here, please note, this is the 200 exponential. There is a spike above it, but the market did not sustain that particular level. So it went back below, and another downside, and another downside. All of these levels could be much better pinpointed if you take the formula we saw earlier this month, calculate the levels you need, and aim towards them by carefully assessing the market from the fundamental side to reassure yourself at least on 80 to 90% that you are on the safe side of the market. This is pretty much on what I'm focusing for the past few months. This is on what I will be focusing on the next 3 to 4 months, depending on how long all of this would be of any use to me. That's why I don't usually recommend to use one and the same system for more than 1 quarter of a market, because the fundamentals, as we know, are shifting. Different things are moving the market every day, but those particular individual things are building up single day after another. Therefore, every quarter there is an earnings type of balance sheet that it's coming out of a single economy or company for the dividends or shares that the particular individual firm is paying to their investors. So all of this have a saying when it comes to trading. We do not undermine one individual fact for the midst of another, because everything is important, but by far how much would actually matter on the rest of the fundamentals. So all of this is connected, ladies and gentlemen. It's very difficult for me to actually explain all of the importance of the market conditions in one single session. That is why we keep developing different systems for you. We are not going to stop, not even for a single day. Therefore, no rest for us to actually find more and more and better ways for you to make profits on the markets. But by far the best way to find out how better you would be able to price in on the market for your individual skills, that would be on the one-on-one session. And most of you here, as I can see, have already been in such a session with me or any of my colleagues at the company. You guys know already what is the benefit of a single session at this one. I have seen the difference that it could make, because it could actually reinforce your belief about any particular market condition, or actually it could question your own skills to better, to keep learning and get better and better every day. The whole idea today was to show you in some of the instruments that we usually trade, where we are right now, what have happened on the market, where the market is at this stage, what were the moves that the market made. So as you can see, all that we have predicted, or let's say technically and fundamentally assessed, have already happened. And we knew about it pretty much longer time ago, as you can see. As I mentioned the last time, one of the particular reasons why we spoke about the Federal Reserve rate hike was not only because the market was absolutely certain that this would happen, but we were also certain that it would happen. So we have priced in our positions along with that expectation. We have made a scheduled webinar especially for this, which actually reinforces the professionalism that the company is dedicating to their individual clients. Furthermore to that, of course, we would continue with some more complex systems. Of course, if you're interested in finding out what they would be, we will be talking about 3 up to 4 individual trading systems, which will involve, again, volume, volatility, and trend indicators, much more different than those that we're looking at right now, as an example to how we can start trading as a professional, because you don't really need any complex system, as I mentioned before. You only need a simple chart, support, resistance, and pivot point levels, and a careful assessment of the fundamental market if you're going to be a successful trader. You don't need 10 or 20 or 30 positions in 1 month, or even 100. I'm always confident, and when I say this, I usually stand by more. I always stand by my word, and I can say that you don't need more than 2 or 3 positions per month, or even 1 single position, as long as it can actually double or at least make 50% on your particular investment. I've made it many times. To be absolutely honest with you, I've been able to double an account with a single position in 1 day, which doesn't mean that I can actually repeat that particular case in the same month. For a very simple reason, fundamentals we have during a single month are actually happening only once. So market conditions to align fundamentals with technicals might not be able to repeat more than once during 1 single month. Therefore, you have to actually think for a single moment whether this particular type of trading is for you, because if you are used to make more than 10 positions or 100 positions per day and you're a type of scalper and you're making enough to be satisfied from your own particular skills, then you should avoid trading like this. But carefully assessing the market by standing beside the better belief that a single position could actually profit more than 100 individual positions, well, that means you are on the way of becoming a professional trader and investor on the financial markets. So for now, that's all for today. I'm going to save the best for last. So we're going to talk about the advanced systems on Friday this week. That would be our last webinar for this month and for this year. But of course, if you're interested to find out what we're going to be talking about, same time, same place, this Friday. I'll be waiting. See you then. Thank you for watching. Bye-bye.